We are delighted to have Santiago Roel Santos with us on the show today. Santiago is a veteran crypto and blockchain investor and founder and CEO of Inversion, a technology-first investment company that acquires and transforms legacy businesses with blockchain technology. Previously, he was a partner at ParaFi Capital and worked in the financial sponsors group at JP Morgan. He holds a BA in economics, magna cum laude from Boston University. Santiago, welcome to the show.
Hey, great to be here. Thank you very much.
It's great to have you. It's a really interesting time in the crypto world. I read some of your really good pieces in Retrospectively Obvious. I think that's brilliantly named, by the way, and some really phenomenal writing. I wanted to first ask you about, can you tell us a little bit about Inversion's business model? It seems it's a little bit different than your traditional crypto VCs. Tell us a little bit about that, and why is it actually named Inversion?
Well, I'll let some context here. So I've been investing in crypto for over a decade now. And for someone listening, most of the people have heard about crypto by now. Back then, it was just Bitcoin. And I've been enamored with the technology, this idea that you can upgrade certain systems that don't rely on a middleman. As an investor, Ty, I think you always want to ask the simple question, can we make an existing business more efficient? And how can you do that? And we'll keep coming back to that because I think that's something that is overlooked when we talk about why does crypto serve a purpose in this world beyond price going up and down. Throughout my career, I've invested in crypto with that lens, which is it's a very useful piece of technology. Before starting Inversion, spent a lot of my time investing in software and fintech. And that is very relevant today when you hear a lot of the conversation around tokenization and stablecoins. So back to your question, Inversion is a private equity company that says every business is going to adopt crypto in one way, shape, or another. And it's going to adopt it because it will streamline their operations. That business can become more efficient with stablecoins by tokenizing certain parts of their business. And I started Inversion late 2024 when Trump got elected for the simple reason that this industry is now regulated, and that a lot of people want to understand, well, what about crypto today is important, relevant for my business or for my portfolio? And I think it's very important to lay the context that we are in a very pivotal inflection point of this industry, whether it's finally regulated, and we can go into that in this podcast. Which is another important thing, which is you never want to be too early. And so I think about that a lot. The timing, I think, is very correct. So started Inversion late 2024 with this idea to go and buy traditional businesses and make them more efficient with this technology. We are structured like a private equity fund. We also have a technology arm attached to the fund that is very critical to drive value, right? Because the other context here is just kind of to lay the platform, lay the foundation for the conversation is private equity historically has driven some value, but the ability for private equity funds to buy businesses and pile a bunch of debt and fire the workforce, that business model is under attack because rates are high. There's too much capital chasing too few deals. And so I think we can do much, much better. I think technology drives a lot of efficiency in businesses. You've seen that over the last 25 years, especially now with AI. And what we're innovating and we're telling the market, look, we can make businesses more efficient. No one's really done it, but I'm incredibly excited because the technology is ready, it's being regulated, and now is the time to really scale it and implement it in businesses.
What kind of business would you say that are the most eligible to be transformed by sort of the crypto, sort of the crypto infrastructure that you've often described in your writings? Like, what kinds of businesses?
Well, every business pays a systemic tax of interchange, meaning it's paying 2 to 3% interchange fee. If you have customers paying credit cards, whether your suppliers are paying with credit cards, your customers on the retail side are paying credit cards, you're paying 2 to 3% to Visa, MasterCard, right? And that, if you're a business and your operating profit is 4 or 5%, think about how impactful it is if you take that business and you improve profitability by 30 to 50%. Why? Because when you implement stablecoins, you can really reduce that 2 to 3%, in certain instances more, right? And it's even more prevalent for smaller businesses that don't have scale. And so we spend a lot of our time looking at small and medium businesses that have challenge margin profile, like less than 10%, but they have a good business. You know, they're serving a valuable product. They have moat, they have brand, they have distribution. But the reality is, like, we like businesses that when we look at the income statement, we see, okay, why are they paying 4 or 5% to payment processors? And the working capital drag of that is very material. So there are certain sectors that we like. A lot of these businesses are moving money in a very meaningful way, and that has a material drag on that business. So financial services businesses, legacy financial rails, anything related to moving money cross-border is an immediate value area that we see a lot of value in.
So, for example, something that comes to mind would be sort of Western Union. I mean, if I've made some decent sized purchases, and I've had to go through the Western Union, and it's a little bit of a hassle. I mean, certainly initially, and it's not as smooth as we've come to like it. So something like a Western Union, perhaps.
Absolutely, I've been very vocal about the pitch of Western Union. We're not a hedge fund. We're not buying public public equities, although we are looking at public companies that might be overlooked. But Western Union is too big for our fund. However, something like Western Union has been around for many, many years. It has a lot of trust in their customers that just have that affiliation. And Western Union pays a lot of money moving that, from the US to Mexico, or the US to the Philippines, or US to India. Those corridors, it's very expensive for them to move that money. And they have to source that liquidity in the end market. All of that money in transit can be reduced with stablecoins in a meaningful way. And let's not forget, a business like Western Union is trading at 4 or 5 times PE ratio. The stock is down 80%. From that standpoint, it's another core principle, kind of philosophy that I have, which is there's a very big disconnect between investing in technology and then understanding how it gets implemented. And a lot of times where I've seen a lot of technology companies fail is because they fail to go to market. They fail to sell the product into traditional businesses. And Ty, I mean, we're in a state of the world where, yeah, everyone's talking about AI, but businesses take a long time to wrap their heads around how to implement technology. Heck, we're still living in a world where a lot of businesses still run on spreadsheets. And so there's inertia to implement new technology. And that's always been kind of the value proposition of something like private equity, which is, hey, let's buy this business that has moats, that has brand, that has distribution, and let's revamp it with best-in-class technology, whether it's AI or stablecoins. But yeah, something like Western Union is, our whole reason to exist is we'd rather take an existing business like Western Union and upgrade its technology stack than try to build a new Western Union from scratch.
Right, because that infrastructure is in some ways is hard to replicate, and particularly the reputation is really important, right? People trust Western Union. I feel like I send the money, it's kind of a little long and painful, but it will get there in 2 or 3 days. Whereas you say the settlement can almost be immediate, and you don't have that friction. I have a question, and I've seen more and more, I suppose, the last 2 or 3 years, where you get 2 prices. You get the credit card price or the cash price, and it's because of these interchange fees. And there's one maybe potential hurdle or something that could perhaps impact the uptake of a crypto real-time settlement is, I have a Costco card. It gives me back a couple of percent on whatever I spend, and some cards give even more. And I could see where some consumers would be like, you know what, I kind of want to use the credit card, even if I have to pay 2 or 3% more, because that's essentially covered by all the rebates, whether it's miles or points or whatever it might be. Is that a hurdle that's kind of a little strange, but relevant?
You're 100% right. I think the innovation is not happening at the wallet layer. So it's happening at the settlement layer, at the execution layer of how that money gets moved around. Meaning, we're not expecting the user to ditch their American Express or their Visa. More so, you can still use a Visa card, But on the back end, that's where a business can save that 2 to 3%. So you, Ty, you can still go to Costco and pay with your Visa card. By the way, you can only pay with Visa and Costco. And there's actually a really interesting, I was reading about this. So Costco initially was only cash because Costco said, this was 1992, Costco management. And there's a great, I was reading the transcript and they said, we don't want to accept credit cards because we pass a lot of the savings to the end user and our margins are 2 to 3%. And they say, if we were to accept credit cards, we'll go out of business. And so that's the reason why historically Costco has been cash and check only. And they wanted you, Ty, to buy membership, that Costco card, because that was their way of filtering through credit quality of the user that would pay in checks. Because the idea was if you paid with a check, but you were willing to pay for the membership, you were credit worthy. So that check wouldn't bounce back. Right? There's a lot of fraud with, bounced checks at the time. And then they negotiated an exclusive deal with Visa where they wouldn't pay them the 2.2% that Target and Walmart pay Visa. They negotiated a fee where they said, we're only going to accept Visa in the store. And that fee went from 2.2% to 0.47%. And so that's important to understand history because think about it. Costco is a phenomenal business. It has great moats. Customers love it because you're getting the bulk warehouse discount, right? But you can only pay with Visa. And that just tells you everything that I think is important to appreciate because most listeners might be saying, wait a minute, I have Apple Pay and I have my credit card and everything seems to be working perfectly fine. It's fast. I can use my credit card everywhere. However, I think most people fail to appreciate on the back end, even a business like the largest retailers in the world still pay 2%. So that context out of the way, I think what we're saying is you can still pay with your Visa card. Visa on the back end is using stablecoins to process because the innovation that is happening here. So why do they charge 2%? Why do they charge 3%? There's been a lot of innovation on the front end, like Apple Pay and credit cards and digital. And what hasn't been innovated is the credit risk, right? Because the settlement time is T+2 or T+5. And so that's what stablecoins essentially collapse to zero. It's near instant settlement. So Ty, you might have a Visa account tied to a Visa card tied to a bank account. That gets immediately funded and the merchant receives that money immediately with stablecoins. And so I guess most people would be surprised to know that Visa is using stablecoins to lower cost to move that money from your bank account to the merchant.
You're right. I mean, I don't think I've ever read or really heard anything about it. I have to admit I haven't drilled into it, but I'm surprised to me.
And that's sort of our edge because payments are hard to understand, at least for the end user, because you're right. You get a lot of benefits from the credit cards in the way of rewards and loyalty points. And, I use a credit card myself. I don't pretend to stop using a credit card. And it's very competitive, right? But it's really this back end infrastructure that has been innovated. And what does this mean? It means that most businesses, especially small and medium-sized retailers, can use stablecoins to effectively get the Costco price that they negotiate with Visa. And that's the key innovation that really gets us excited to go and buy a retailer like that has, 3 or 4% margin. And we go in there and we say, we're going to use stablecoins on the back end. The end user can still use their Visa card. And, you can improve margins by 30 to 50%. That's huge.
For folks, that's a lot.
I would even, yeah, I mean, it's sort of, you remember 20 years ago when Amazon was getting started, the name of the game was just in time delivery, same day delivery. So just in time manufacturing, right? For cars in Japan and Korea, companies like Kia, companies like Toyota, they really innovated just in time supply chain. What you're seeing now, the analogy is for stablecoins is just in time money movement. Because now the settlement, the execution happens just in time, near instant settlement. And that removes credit risk, that removes a lot of the fees for verification that have historically had to happen and would take time, right? Because you have 5 different intermediaries checking that when you swipe your card that you're good and your bank is good and the acquired bank is good and the network there, like Visa, approves all of that. And there's all these different checkpoints. So keep that analogy in the back of your mind. Just-in-time money movement is going to transform every business. It is incredibly impactful because end of the day, every business receives and sends money, whether you're paying your employees or you're receiving money or you're sending money to suppliers. And I can't underscore the economic impact that moving away from this historical financial system that predates the internet to one where money moves instantly, it has huge positive economic repercussions, to the scale of AI, by the way.
I wanted to shift gears a little bit, and in your Substack, you recently wrote that crypto has effectively built massive highways ahead of demand, and the money that can be made by those who can take great advantage of the protocols and not by the builders of the infrastructure. And I'm guessing that you're figuring out a way, inversion and folks like it are trying to take advantage of that infrastructure. That's like I think you wrote it's a brilliant highway, but there are not a lot of cars driving on it.
That's right. There's been over 100 billion invested in this infrastructure, this technology that allows us to move money just in time. And now is the time to implement it. The good thing is this technology has been around for now a while. It's been battle tested. So there's been cars that are currently moving in this highway, but it's like that classic picture of having 5 highway lanes and bicycles on it. I think it was in China that you saw this picture. And I think about that a lot because, right now it's not a technology problem, it's a go-to-market problem. Unfortunately, while most people have heard about crypto, it's not relatable for them. They don't understand how to implement it. They don't understand how it fits in their day-to-day life. And consumers and businesses don't really want to change. There's a natural inertia to try new stuff unless you see a clear benefit and utility. So Ty, if I were to come and tell you, hey, look, you can move money from the US to, I don't know, Korea, or the US to Singapore, and you can do it very fast and very cheap. And you're going to then ask me, how do I do this today? And I'm going to then, some other company will tell you, hey, you need to download a wallet and careful because you need to memorize 24 words. And if you get hacked, you lose your money. And then you got to call the receiver and tell them how to figure this out. And they have to download a wallet, and they have to also make sure they recognize 24 words and never lose them, never share it to anyone because they get lost. You've lost them.
It's in the too hard bucket. Yes.
And what are they going to do? They're going to resort to saying, you know what? Western Union's around the corner, and I'd rather go to Western Union. And I get they charge me 5% or 4% or 7%, but I know that they're going to get the money, and I want to go about my life. And that's, by the way, you might think that that's crazy, but that's also how large businesses operate, because they'll likely tell you something to the effect of, hey, moving money is not my core business. I want to make sure that my supplier or my employee or anyone that walks in my store can pay easily, because I can't afford to lose my customer. And so I sort of have accepted in my business model that I need to pay these companies like Visa and MasterCard 2 to 3 to 4% per transaction because everyone has a Visa card. And so that's really kind of the core. When I started thinking about why we needed to exist as a company, is for this reason, because there's always resistance from companies, and it's still really hard to implement this technology. It's becoming easier by the day, but we're here to make it extremely easy for businesses to implement our technology, to use and leverage this technology in a invisible way, in a seamless, frictionless way, where at the end of the day, the end customer doesn't really have to figure out anything other than if they have a Visa card, they can use it, and we'll pass a lot of those benefits over to the business, right? And it's real. It's happening. Companies like Visa SpaceX, some of the larger businesses are using stablecoins today to capture this value. Um, I would say the biggest unlock was two pieces of legislation in the US called the Genius Act that recognized that stablecoins are cash instruments. They are regulated. So that matters a lot, right? Um, and now you have the Clarity Act coming up on the Senate, which introduces more clarity on the regulatory framework for these new instruments.
Quick question on the Clarity Act. If I recall correctly, it looks like it might have gotten stuck over the last couple of weeks. That some people, some of its original supporters didn't want to support it, didn't like what was in it. So it may be dead in committee or needs to be rewritten. Am I correct in that? And if so, what were some of the issues with it?
Yeah, there were a couple issues. So you are correct. One of the larger companies in the space, Coinbase, pulled its support from the bill. They didn't like a couple of things on it. One of them was the ability to share rewards back to the end customer who held the stablecoin. Important to note, Coinbase has a direct interest at stake because they have a partnership with Circle. They issue this stablecoin called USDC, which is very prevalent in the US. And they make about 20% of their revenue on stablecoins, stablecoin related activity. A lot of that is yield. If they have deposits, they'll buy treasuries, they'll capture 3 to 4%, and then they'll share some of that with the end customer. So it's a material line item in their P&L. This new legislation, as it was proposed by the Ag Committee, I believe, made it harder for Coinbase to pass on some of that rewards to the end user, and so naturally they had my understanding is they had problems with that. My opinion is, it's probably the large financial institutions that have a lot of deposits that are worried naturally about that, losing deposits to going to stablecoins, right? And where I am actually I'm more positive on the bill in its current form because it makes a distinction between how you can pass through that reward over to the end user. Going back to the example of Costco, if you're delivering utility in the form of stablecoin, meaning if it's being used for day-to-day transactions like paying for milk, then you can pass some of those rewards back to the customer. If it's just sitting like a financial instrument in a Coinbase account, which is non utility driven, so to speak, is just sort of financial instrument, then you can't pass on that yield back to the customer. And I think that's okay. I mean, at the end of the day, I want stablecoins to be used for day-to-day economic activity. I think it's super important for the industry to keep growing, and it will only grow in this way in a very meaningful, I think this bill in its current form would be a win for an industry that has been hampered by regulation. And so it is very positive. And I would love nothing more that if every business starts accepting stablecoins, it can save this 2 to 3% that it's paying. And that's really what we're trying to solve for, not so much if one company wins versus another. I think system-wide, we can all agree on that if retailers save 2 to 3%, it is a win for them. It's a win for the consumer. It's a win for businesses. And it's really the real economy of America. Your retailers in Main Street that are really suffering the most by paying these high fees. And now we have a new way to do it. And so I would hope that this bill gets passed and we can move on.
So I have a kind of perhaps a silly or a very fundamental question, and it goes right directly to how comfortable people are feeling with using, having stable coins and rather than their account. Is when do you think we could potentially, if ever, I guess the banks could probably do it. If I could, instead of when I open up my Chase account and I see all my accounts, right, or Schwab as the case may be, when do you think I could have an account that says this is my stablecoin account, and then I can sort of seamlessly move things in and out from my accounts to stablecoin, pay, instead of Zelling somebody from there, I can quote unquote Zelle or transfer somebody, with a stable coin rather than than cash as it stands today. Are we, is that a long time away?
That's a 2026 event, Ty.
Wow.
Yeah, by far. Yeah, it's one of those things where gradually, then suddenly,
Mhm.
and as I said, a lot of this technology exists. The missing piece was regulation. So at least in the U.S., I think you will be seeing more and more large financial institutions use and allow their customers to hold stablecoins through their traditional bank accounts or brokerage accounts. If you're a customer of Robinhood, if you're a customer of certainly Coinbase and others, like you already have this ability. PayPal has its own stablecoin as well. Shopify also is now supporting stablecoins for merchants. So it's already happening, and now I think I wouldn't be surprised if the vast majority of financial institutions allow customers to hold stablecoins directly in their bank account, and certainly as you start tokenizing other stuff, stablecoins are going to be the default um, digital form of money to go in and out and move money just more seamlessly. So it's going to happen. It's probably going to happen faster than most people think, and it will deliver a lot of utility.
I could see that. I mean, if I wanted to buy something overseas, if I could transfer stable coins, from my Chase app or from my Schwab app, it gives me, not only me, but a lot of folks, oh, if it's on Chase or if it's on Schwab, somebody who's, I'm probably not the Robinhood generation. It would give that sort of patina of safety, and if not safety, if not approval, that's going to make uptake of this, very significant.
You said something very interesting there. As good as credit cards are, the amount of failed checkouts that exist today in e-commerce are staggering. People inputting their address incorrectly, credit cards expiring. So if you have a subscription, sometimes that fails. Credit cards expire every 3 to 4 years on average. So it's a material drag on businesses that, again, I understand your core business is developing a software, making sure that people like it, or selling stuff online. It is rather very unfortunate that not less than 1%, but a decent, I would say, I think in certain businesses, greater than 5% of all of the traffic that happens on their website and wants to purchase a product that has a failed transaction. And there's a lot of churn associated to the fact that you're using a plastic. You want to, especially when you're buying something overseas, for whatever reason, your credit card gets declined. That doesn't happen with stablecoins, because you send that stablecoin from your account to the other account. That money is received instantly. The merchant gets the money, is able to use that money to buy more inventory, and doesn't require as much credit. And so you start seeing the vast economic impact of this just-in-time money movement. That business, by the way, might say, hey, Ty, if you're going to pay with stablecoins, we'll offer you some sort of discount, right?
Right.
And the same with it. Historically, you said it earlier, right? Some businesses say, hey, if you're going to pay in cash, we'll offer you some sort of discount. And they'll pass through some of that benefit of the end user. So it's a win-win. It's a win-win for consumers. It's a win for businesses. And that's the most important thing, for economic activity.
I want to do something that you wrote recently, and I think is very sort of relevant, because what we've seen since Bitcoin hit an all-time high in October. I think you wrote, all of this sits within a broader macro reality. Crypto is a high beta asset class, and today the market is priced well above historical norms. Gravity eventually asserts itself. From here, the probability of downside over the next year is higher than the probability of further upside. It's been a rough 3 months for crypto investors. I should say crypto investors who are in some of the major coins. I mean, I watch the major coins. I don't really watch the minor coins so much. Are you saying that this is, we might be in for potentially another 2022 where could be a painful year if you're a coin investor?
Well, Todd, I mean, I can't predict markets, but what I can tell you is from it is hard to justify why something is valued at 50 times price to revenue, or 100 times price to revenue, or 200 or 400 times price to revenue. And so I think the market's caught up in this tension where we're getting all the headlines that we want. We have Larry Fink. I was just in Davos. You have Larry Fink, the CEO of BlackRock, saying the entire world should tokenize. And it is in the conversation, and we're getting regulatory clarity. All of the things that we've dreamed about as an industry are coming to reality, but that doesn't mean that the price goes up. And a lot of times there's this kind of effect where I call it the price adoption paradox, because as something starts getting adopted and you start generating revenue, the market appreciates, okay, we're going to then compare you against other things that produce revenue. And so I think Bitcoin deserves, it's in a class of its own, right? I think, why is it a class of its own? Because it acts more like digital gold, right? And the market generally understands that it is an interesting instrument to hold in your portfolio. And you have ETFs, and you have your financial advisors believing it or selling it to customers. And it's sort of now made its way into the broader Wall Street Salesforce apparatus, and people want to go off of zero. So how do you value a commodity? It's just supply and demand. So as long as people believe that Bitcoin is interesting as a digital gold instrument, I think people are probably doing a comparison against gold, a $30 trillion commodity, and Bitcoin, a 2 trillion digital commodity. And so it's saying, okay, it has interesting upside. It's a good option to have in the portfolio. So I would put Bitcoin to the side because it's a commodity. Everything else is anchored and compared against tech, against Visa or Stripe or other fintech companies, or other technology companies. And so systems like blockchains like Ethereum, Solana, Ripple, so on and so forth, all of these are essentially businesses that are competing for the business of Visa, doing transactions and monetizing these transactions in a digital database, a digital ledger. And ultimately, at some point, it is really hard to justify the valuation of a lot of these networks. Give you some perspective. Ethereum is worth 350 billion market cap. It produces $1 billion in revenue. Now, Ty, if you were to go out to Wall Street and tell them, hey, look, I'm going to sell you a business that is valued at 350 times price to revenue, I think you'd be a laughing stock. Not even the wildest AI companies valued at that level. Not NVIDIA, not the highest flying AI companies.
Only Elon, maybe.
and not even a company like Tesla, right? And so the issue is, of course, the other problem that you have is what's the quality of that revenue? Because you think about a software as a service company like Salesforce, it has recurring revenue. It has long-term contracts with businesses. It is providing real utility in the form of a CRM. And there's contracts, right? Multi-year contracts. Whether that contract's going to be renewed because of AI is a separate conversation. But at least you can wrap your head around, hey, it's valued at 8 times, or it's valued at 30 times revenue. Okay. And then you start asking other questions around profitability and the quality of the product. And this goes back to the point around utility. What is the utility of crypto today? A lot of it, unfortunately, is not what we've been talking about, not stablecoins embedded in real businesses or payments infrastructure. It is meme coin trading, and it is speculating on these tokens. And sometimes you need something like that to justify investing and proving that the technology can work. But I think the quality of that, you don't value casinos like recurring software businesses. And it's certainly, if you're going to value a casino, it's not going to be valued at a higher multiple than technology businesses that have recurring revenue. And that's really the problem that I have. As much as I love this industry, I can't help but take a more active approach to making sure that the technology gets implemented and drives real utility. It's going to help us with regulation. It's going to help us with proving the skeptics wrong. And so I think crypto asset, so I'll give you another historical anecdote. I love history. So when the NASDAQ crashed in 2001, you had the peak of the dot-com bubble. The NASDAQ fell 78%, 80% during that year. Internet users were at the time around 400,000. It took the NASDAQ 15 years to recover from that all-time high. Meanwhile, internet user adoption exploded. It grew, I think, somewhere to like 20 times during that time frame. And what I'm trying to tell you here is my working thesis is we're going to continue to see more adoption. We're going to continue to see more and more businesses, more and more customers see stablecoins in their bank account and be able to use them. But as an investor, you got to ask yourself, is the multiple that I'm buying a business the correct one? Because my argument is most of these businesses are wildly overvalued on some narrative and future idea of this technology really being proliferated across the world. And that takes a really long time. And as an investor, you should really ask yourself, first, if the business is good. Second, am I buying it at the right price? Most investors stop in step one. Say, this technology is wonderful. Businesses are adopting it. You're seeing Visa and BlackRock and JP Morgan and everyone talk about it. Let's go out and invest in some of these projects. And they stop there and they don't ask, okay, should I be buying this business for 350 times? Like, is Ethereum worth 350 billion? Is Ripple worth 200 billion? Is Solana worth 80 billion? And the answer to that is probably, gosh, what do I need to believe for that to be true? And as an investor, you want to protect capital first.
You make a very good point there, and I really appreciate when you explained it in that article. Is your problem actually comes when you start getting in some revenue, because then there's a benchmark, then they can benchmark you against other things. If you didn't have revenue, you could always say, and in the way that Amazon didn't show any real revenue for probably 3 or 4 years, if I recall correctly, is that there was always that sort of hope, and once the cash flow materialized, you're like, oh my God, it's 350 to 1. I don't want to really buy that here. It's really counterintuitive, but those first dollars that come in positive revenue can be very, very risky. I think that's an amazing point, actually.
I even looked at a business like Amazon, and Amazon IPO, I think it was 97. It delivered a great product to be able to buy books online. It set the platform to sell more goods online. It wasn't really profitable because they were reinvesting most of its cash flow in expanding rapidly into other sectors of e-commerce and kind of becoming the dominant player that it has become. But even at the craziest evaluations in 99, it was valued at like 30, I think it was 27, 30 times price to revenue. So again, high, not crazy compared to Ethereum that is valued at 300 to 350 times price to revenue. And so like as a fundamental, through a fundamental lens, you can't make sense of these valuations. I do appreciate that a lot of this market trades on narratives and momentum and memes. I think markets in general have become less value plays, have become more momentum driven and flow driven. And so I'm not here to tell you that there is a version of this world where markets and prices continue to go up, but at some point gravity takes its toll. Like at some point, a business cannot trade at 350 times price to revenue. If it is a technology services business, if it's a commodity, totally different story. Because Bitcoin, by the way, has very little fees. In the same way that gold is not a productive metal in that sense. It has very little utility other than people believe that it is a way to show social status, and it's relevant for weddings and it's relevant for jewelry. But it's a terrible semiconductor. It's not a very good store of value because you got to secure it, you got to move it, transport it. But gold over centuries has become this status symbol, and it's turtles all the way down, right? My argument is everything other than Bitcoin is a technology, should be viewed in the lens as a technology business. And I can't think of a business that traded at that level for a long time. And so eventually, I think 2026, 2027 is the year where crypto goes mainstream and prices stabilize and come back to reality, because people finally, to your point, start comparing it against the technology that you're disrupting, right? Visa, is a comparison. And whenever someone can make a comparison, that's where things, start normalizing back to real life.
It's a really good point that you make, that we should consider Bitcoin and some of the other infrastructure coins like an Ethereum or Solana differently, because Bitcoin doesn't Bitcoin is sort of digital gold. It's having a little bit of a rough patch, despite all the the digital treasuries and the ETFs. I think perhaps that it needs another wave of of support and enthusiasm that it's sort of lacking right now. But it's a very good point that we should separate the thinking between those two. And I think too many people, at least not, who are not the sort of native crypto investors, tend to lump that whole asset class together. I want to switch gears once again, and because you were an early angel investor in Poly Market, sort of the prediction markets where you can bet on sort of different things. And you made a really good point that the truth often comes. The market always sniffs out truth. Poly Market has gotten a lot bigger than it used to be, and you can sort of bet on it now. What are you thinking about it today? Is it going to get even bigger? In terms of, and do we have that the problems with sort of the casino problem, where if you get people in there and you churn them out, you break them, and they're no longer clients. Where are you thinking about prediction markets now?
I think prediction markets are one of the more exciting categories, not just in crypto, just in general. My thesis back when I invested in the early seed round of Poly Market was prediction markets surface truth. Why? Because money's on the line, and a conversation is better when you're talking about the odds of a political election, or the odds of some geopolitical risk, or any event really that has liquidity behind it. Is what are the odds of that happening? And at the time, my thesis was, look, there's general distrust in the media. The media had gotten wrong. Even the Nate Silvers of the world gotten wrong. They missed the first Trump election. The reporting is questionable. And look, you have all these experts coming on TV and writing articles, but when there's no value on the line, anyone can say anything, and the market has a memory of goldfish. So it's the best job in the world, because you can keep adjusting your predictions. Everyone forgets about them. But you cannot, unless you want to lose money intentionally. I think rationally the market wants to price odds more efficiently, and it will, because there's arbitrage opportunities. And so I think it's fascinating how in day-to-day conversations talking about who's going to win the election, it went from being, well, I think this or that. It's like, well, the odds are 90 to 10, like 90% this candidate, 10% the candidate that you like. Tell me why the market is wrong. And I think that's like an anchoring effect to any conversation. So prediction markets, I think in their purest form, allow us to have a better understanding of probabilities, because markets, there's money on the line, and market surface truth. The activity, of course, you can bet on political events, sport events. So a platform like Kalshi has way more activity on people betting on sports or the Oscars, right? And that type of entertainment sports category. Poly Market is a bit more diversified, but I think it's pretty fascinating. It's one of those products that most people don't think it's crypto. It's just, oh wow, this is just a way to, if I have an edge, if you, Ty, have studied political science, or you're a meteorologist, and you say, hey, I have a good understanding of weather patterns. I think there's going to be a Category 4 hurricane happening here in hurricane season. There's a market on that. Now imagine, go even further, say, hey, I'm a homeowner in Florida. I have hurricane insurance, and hurricane insurance is only going to pay out X or Y. I say, well, what if you could bet on a market and effectively hedge the unfortunate event where your house gets wiped by a hurricane? So you start seeing how this can become and really transform certain industries like insurance that don't price risk in real time, right? When you buy hurricane insurance or flood insurance, it's just on an annual basis, and that premium is kind of priced in a black box. Now you have something else to be an oracle for that risk, which is there's a market on a hurricane happening in southern Florida this season. and it's the odds are, 80% probability of a category 7. And so if you own land there, or you own a home, whether you're then that's sort of the utility that a prediction market can have. When I generally think markets are efficient in some ways, but inefficient in many ways. And it's, if you can identify and fix that friction, you can deliver immense amount of value.
I think you're right. When I look at some of these these contracts, like the poly market contracts, like the the Fed the who is going to be Fed chair contract is great because there's so much volume in it, and you feel like there's so much volume in it that it's not manipulable, and B, you can get in and out sort of easily. I mean, if you just your example, if you can say, I think it's going to be a category, if I'm a homeowner and I don't have enough insurance, and there's a market big enough for me to go, and for a lot of people to go and say, I'll buy the odds of that happening, to sort of to hedge my house in a way that'd be tremendously useful. It'd be like, in some ways, having agricultural contracts for the corn and wheat farmers, and in a kind of an interesting metaphor. I wonder though, one of the things I guess we shouldn't be able to bet on is things like assassinations or terror attacks, where obviously you don't want people to bet on that and then try to sort of impact the underlying, so to speak. Is there any kind of regulation on prediction markets at the moment?
So assassination markets are banned, I believe, for obvious reasons. There is regulation around prediction markets. The CFTC regulates that. And so I think you're going to see more and more regulation this year. There's been the biggest kind of topic in front of regulators is this insider trading, right? If you're an insider and there's a market around a particular thing that you can influence, you should recuse yourself and not be trading on that market. To your point, if you, for instance, if there's a market on how long this podcast is going to last, well, obviously, I think you and I shouldn't be trading on that, nor do our people that have knowledge, nor should we be giving money to people that know on our behalf. So I think there's just general common sense that needs to be introduced, but it's going to happen. And I would be, if I don't like to give advice in any way, shape, or form, but I will give this advice: please don't trade on prediction markets. If you have inside knowledge or can influence that market, it is likely illegal. And if you think you can get away with it, it's likely not going to be the case.
You're absolutely right. We're seeing that, in sort of, sports betting, where they have these parlays, points and a half by individual players that can be easily sort of manipulable. Maybe we need to step away from that because lots of prosecutions, could potentially hurt the entire business in general. Last question. If we think that these prediction and poly market type analogs are going to grow substantially, with perhaps better regulation. Is there any way to monetize that, or is there anything listed that the common investor can get into to sort of get a little leverage on this?
On prediction markets?
On prediction markets, on prediction markets, basically.
I'm not aware of it at the moment. I think the immediate question for me is, you have these prediction markets. How does that impact traditional businesses like insurance or the media business? And so, for instance, now you're seeing a lot of media companies use prediction markets. The Oscars, I think, are going to come on. I think the Emmy Awards use prediction markets in real time. So you saw so maybe there's higher engagement, right? If you're a media platform, you have more viewers kind of tuning in. Everything is an attention game. And for better or for worse, the world is becoming hyper financialized. And you could, betting on certain outcomes and talking about odds maybe keeps people more engaged, right? If you're gonna sit through the Oscars, I think the likelihood of you sitting down and seeing end to end goes higher if you can put some money on the line and bet on who's gonna be best actor or best actress or best movie or best soundtrack. And is that a good thing? Is that a net positive outcome for society? That is not for me to decide. But I think it begs the question of, how is this technology being used and implemented? And I would caution against leverage, just in general, right? I mean, it's okay if you want to play around with a little bit of money here and there to just have fun with your friends. It's not okay, I think, if a platform like a Polymarket or someone that is using a Polymarket says, "Hey, Ty, I see that you're coming to the casino." It's like high rollers, right?
Mm.
People that are gamblers and are addicted to gambling, unfortunately, go bankrupt. It's sort of a matter of not if, but when, because the more time you spend in the casino, the higher the likelihood that you're going to go bankrupt, right? It is manufactured.
The house edge. It's a mathematical fact, with occasional anomalies.
Exactly. So casinos are great business models because they have all these cameras installed to understand, who's the sucker and how to serve you a drink and make sure that you're engaged. And it's like every time you want to leave, they pull you right back in, right? So they'll offer you a sweep to say, "Hey, Ty, you want to fly to Vegas? We'll give you a high roller suite and we'll give you all these perks." But at the end of the day, it's value destructive. And so I think that's where I draw the line around, in the businesses that we want to go and buy and acquire. It is more of the use case of, hey, what if we buy an insurance company and we can use prediction markets to price risk in real time, to lower maybe premiums for the end customer that has exposure to hurricane risk or flood risk. And we can use prediction markets to get a better understanding of what the odds of that happening are. And that lowers our internal costs. That makes us more competitive in the market because I can offer an insurance policy at a cheaper rate to the end customer. Like, that's real shit. That's the thing that gets me excited. That's why I love crypto, because I fundamentally believe that that's the impact that you can have. But it's a classic Prometheus, myth. We bring fire to the world that could be used for good agricultural and, cooking and industrial processes, or it could be used, to burn a village on fire.
I love your analogy with the Oscars. If you have a bet on, you might watch the Oscars more closely. That's exactly right. Because when I started playing fantasy football, I never watched so much football in my life because I had sort of skin in the game. So 100% right on that, and that's a really great insight. Well, Santiago, thank you so much for joining us today. It's a really remarkably interesting conversation. I look forward to future conversations where we look at how this is all going to develop. Thank you once again so much.
I appreciate that. Thank you for the time.